Guys, imagine you buy a house today in the UK and in just 12 months, 1 year from now, it's risen in value by 12%. That's an average of £26,000. £26,000 worth of equity in your pocket by doing nothing except for just owning and sitting on the property. Fast forward another 12 months and it's gone up by another £22,000. That's £48,000 in just 24 months. And in that same period, you've seen a global health crisis, you've seen a war in Europe, you've seen a cost of living crisis, you've seen inflation growing out of control, you've seen a recession, 2 consecutive quarters of GDP decline, you've seen supply chain crises throughout Europe. But in that period, no negative growth despite all of that. Yes, you've seen a slowdown in the rate of growth, but still growth overall. The question is, guys, what does that signify to you in terms of what's going on in the UK housing market? Is there a UK housing market recession going on in that period that I've just described? Is the market crashing? Is it cooling off? Or is it actually growing? Today, we're going to look into that using 30 years of data, 30 years historic UK property market and UK economy data to answer this question in more detail today. What's up, guys? Welcome back to the channel. My name is Warren. I am a banker here in London and a property investor across the UK. My goal is to live free and independently from property. So I'm looking for an income of £3,000 per month from property in the next 5 years. If that's what you're about too, you want to live free and independently and enjoy your life, subscribe. That's what my content is all about. So guys, we're living in unprecedented times. If you're a millennial like me, you've seen a lot economically in the period of your lifetime. We have seen an economic crisis, a global credit-driven economic crisis driven by the banking market and a lot of irresponsible lending, particularly around houses, creation of securities, mortgage-backed securities, over a decade worth of economic hardship.
Mr. Speaker, it's taking time, but the British economy is healing after the biggest financial crash of our lifetimes.
A lot of us here, especially in the UK, are sick and tired of the word austerity, which has really been over a decade-long phenomenon in our economy. In 2016, we left the EU.
British people have voted to leave the European Union, and their will must be respected.
And the knock-on effects are really being experienced now. We're seeing breakdowns in supply chains, which has been compounded a lot by the last 2 years during the global health crisis and the war now. We're seeing a lot of trade issues. In 2020, we saw a global health crisis, okay? We saw furlough left, right and center. We saw work from home becoming the new norm. We saw Zoom take over the world. We all live on Zoom for work these days. Small businesses were annihilated. And we saw one of the biggest transfers of wealth on record during that period. And most recently, we've seen a war in Europe. We've seen fuel price increases leading to a cost of living crisis, which has led to record inflation and lots and lots and lots of quantitative easing, guys. So with all that being said, guys, that's setting the context of where we are. What is the effect on the UK housing market, guys? A lot of you have been saying in my previous month's videos that we're in for the biggest UK housing market recession on record. I'm seeing stuff in the comments. I'm seeing predictions of 30%, 40%. Others of you saying that we're just seeing a cooling of the housing market. I did a poll not so long ago. A lot of you said that we're just seeing a cooling off. But today we're going to put some science behind this, guys, and actually look at data in more detail. So let's get straight into it, guys. The last 2 true UK housing market recessions, the biggest drops in the UK housing market in prices and values of property on record, happened in 1992, where we saw a drop of 7.3%, and 2009, where we saw a drop of 15.6% in a 12-month period, guys. Now that might be surprising to you, it might not be, but the largest drop we've ever seen in the UK housing market has been 15.6%. So first of all, right from the start, guys, when we're talking about drops of 30%, 40%, 60%, we have never, and I mean never, seen anything like that on record. Not saying that it can't happen, but I'm just talking about data, just purely data. I'm giving you the facts. We've never seen anything like that. So let's take a look at the first ever UK housing market recession in 1992. And let's look at what happened prior to that, because that's always a good indication of how we got to that stage. Okay, so we saw sustained strong annual UK housing market growth for 5 years before that, averaging at round about just under 17% per annum. Now that's what we call real growth in the UK housing market, guys. 17% per annum on average for 5 years. A lot of people did very well when it came to their personal wealth, okay? And that peaked at a growth of 33% in 1988, okay? Now in parallel to that, what we saw in the economy is interest rate rises sustained for the 4 years prior to that, and interest rates peaked at 13.9% in October 1990. GDP was at an average of 4.2% growth per year for the 6 years prior to the crash, and then we got the UK property market crash, guys. So let's just recap what we saw in the run-up to the first major crash on record in the UK housing market. Was really strong, sustained, I'm talking 5 years plus growth in the UK housing market. We saw sustained interest rate rises, we saw sustained GDP growth, and then we see a crash, okay? Now let's look at what happened in 2009 and see if there's any similarities between the build up to 2009, the next major crash, and the build up to 1992, the first major crash. So in the build up to 2009 crash in the economy and in the property market, once again, we saw sustained strong annual UK house price growth for 10 years this time, averaging at 11% per annum. That's over 100%. Again, very strong, sustained, elongated amount of time of healthy growth in UK property prices. The growth peaked at 28% in 1 year, in just 1 year in 2003, okay? And then we also saw, once again, sustained interest rate rises for 5 years prior, peaking at 5.7% in July 2007. GDP, again, was growing yearly. We saw an average growth of 3% per year for 10 years, which is very healthy. Sustained average growth of the UK economy at 3% for 10 years. And then we saw the crash, guys. So we're seeing the same patterns. Sustained growth in the UK housing market, rising interest rates, sustained growth in the economy and GDP, and then you get a crash. And I think one of the best ways to picture this, to use a metaphor, is imagine a balloon being blown up and it's growing for a sustained amount of time, and then you see what seems like the sudden bursting of the bubble. And that's what happened in the UK housing market in 1992 and 2009. So the question is, guys, what are we seeing now? Are we headed for a UK housing market recession? Are the signs pointing to an incoming housing market crash? Are they pointing to one of the biggest crashes on record? So let's start, guys, by looking at housing market growth. We've seen growth of 9% in 2021, and we're on track for around about 6-7% in 2022 this year. And by the way, the average growth in the UK property market over the last 5 years has been 6.7%, right? So this year we're below that, and the year previous we was above that. We're nowhere near the sustained 11 to 17% annual growth. So there's still a long way to go, right? In terms of the pattern that we saw in the run up to 1992 and 2009, where we saw a sustained level of annual growth for 5 to 10 years of 11 to 17% in the UK housing market. We're not there yet. We are not in what you would call a housing market, housing price boom right now. We've had 2 good years, of course we have, and those have been created more out of external factors. And when I say external factors, I'm talking about stuff like the stamp duty holiday that was given during the global health crisis. I'm talking about the search for space during the global health crisis, where many people, not just in the UK, but all over the world, started to move outside of cities. They started to buy houses, spacious houses, because they didn't want to be in cramped cities and flats. So a lot of people decided, hey, this is a good time to move. We were working from home as well, so you no longer had to live, within a certain catchment area or a radius of your office, because we was all working on Zoom during that period, and we still are now. Now let's talk about base rate interest rates, guys. We have seen an unprecedented rise in the level of base rate. In just 1 year, we've gone from 0.1% to 2.25%. Huge increase in the space of less than 12 months. I think we'll all agree there. And that's been done to combat the inflation that's running rampant. But what people leave out a lot of the time is we are still, guys, at an historic low base rate relative to the past 50 years, okay? For example, pre-2009, base rates were at 5.7% in July 2007, and way higher than that, all the way up to 15% if we go back to the 1990s. My point is, guys, yes, mortgage rates have gone up significantly for many of us, myself included, right? Over the last few months, where we've seen the particularly big hikes. But relatively speaking, compared to the last 40, 50 years, as you can see on screen now, we're still at a relative low. We have had higher rates than this before, and we've been paying higher rates than this on our mortgages, on our loans before. The difference now is that we're in a cost of living crisis. Yes, the point needs to be made that there's been no compensating real wage growth. We're in a cost of living crisis. So wages are staying flat, costs are going up, mortgage costs are going up, energy costs are going up, and that's what's squeezing consumers like you and I. However, as it relates to property, right, and assessing whether we're in for a property market crash, not an economic crash, a property market, specifically a housing market crash, we're still at a relative low relative to other periods where there has been one. And then also, let's take a look at GDP, right? So for the last 5 years, we've seen GDP growth of 1.74% in 2017, 1.25% in 2018, 1.37% in 2019, minus 9.27% in 2020. And we know why that was, the C word. And then a growth of 7.4% back to positive growth in 2021. And that 7.4% growth in 2021 was really a recovery of the decline, right, in 2020. It wasn't new additional growth. The economy wasn't expanding. It was just recovering a lot of the lost ground during 2020, where a lot of businesses were closed, people were laid off work, etc., etc. Okay, so the economy hasn't grown. It's a bit of a red herring. Truth be told, since 2009, the economy has not been expanding and growing at the rate that we saw prior to the last crash in 2009. We need to see growth for a lot longer. We usually see growth for a lot longer and a lot more consistency prior to a UK housing market crash, if we're going by 2009 and 1992. I do not think, okay, based on the trends that we've seen in the build up to 1992 and 2009, I'm using purely data here, that we're in for a UK housing market crash. This isn't wishful thinking, I'm just going by the data. And just a few additional things that I think will help, or has helped certainly, to save, as it will, prop up the UK housing market. First is quantitative easing. I'm not going to go into huge detail on what quantitative easing is, guys, but essentially it's the government printing money. One of the effects of quantitative easing is that it tends to underpin and keep asset prices at a certain level. Yes, artificially, so they do normalize, or do need to normalize eventually, but that's one of the effects of quantitative easing. And we've seen that in the UK housing market, certainly post the 2009 crash. Yes, it crashed then, but if you notice, especially in places like London, it recovered pretty quickly, okay? And a lot of that was down to quantitative easing. Secondly, guys, is the stress test. So I worked in banking. I started in 2008. One of the things that the government introduced in the banking sector when it comes to mortgage lending is stress tests. These were brought in 2008. I was there. Mortgages over the past 13 years have been underwritten by banks to withstand a 3% increase in interest rates. Stress testing, guys. So what am I saying? Mortgages have been underwritten in a way that's a lot more responsible than they were prior to 2008. They have been lent to withstand periods like this, okay, guys? And then lastly is the stamp duty threshold changes. You'd have seen that in the most recent mini budget by Kwasi Kwarteng. We already seen this happen. We've seen threshold changes. It happened during the global health crisis, where they gave people a stamp duty holiday. The net effect of that, guys, was that property prices rose. This is a permanent change to the thresholds for new first-time buyers and people who own a home up to 250,000 and I think 400,000 respectively. So guys, those are my thoughts, yeah, on the property market using historic data. I know people disagree with what they think is going to happen, but let me know what you think in the comment section below. Let me know what data you're using to base your opinions on, guys. Check out my property dashboard that I use to assess properties and buy properties, and I'll see you on the next one.